story is going to flip in terms of profitability and inflation.
This is not a market of everything is going to go up, everything is going to win.
We're in a very low risk environment, and the feeling is you can buy practically anything.
When we look at consumer finances in general, there's still potential for the consumer to spend over time.
I think all those things point to an economic cycle that lasts just a bit longer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is ECB Day from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio with your equity market down 10 on the S&P. We're negative 0.2% alongside Lisa Abramowicz and back together with my partner in crime, Tom Keene. TK, welcome back. The ECB decision just around the corner.
The ECB decision, I don't know if it's a big deal, John, or if they'll do anything as well, but I got to admit, this is where Lagarde gets tested at the press conference. Does she want to be assertive like Draghi was? I have not observed that yet.
The risk today, Tom, is you conflate a reduction in the pace of purchases in the PEP program with any kind of signal about the degree of support that goes beyond next year. I think that's the risk today. You can call it taper if you want to, but you've got to be really clear that a taper at the ECB could be very, very different to a taper at the Federal Reserve.
I'll go with that as well. But, John, I just don't, with the pandemic and the uncertainties that are out there, again, every central bank wins by delay. I don't think ECB is any different.
And every single line in that news conference, Lisa, every single line will be interrogated by pretty much everybody.
Yeah, and that's the question, because Christine Lagarde doesn't always deliver in that type of circumstance. I love the idea that we're going to be talking about a dovish taper. That's the new code for all of these central banks.
I missed
yes,
that.
Exactly. UBS coming out talking about the dovish ECB taper. And
we've got to be really clear about this. They came out with the size of the envelope, 1.85 trillion euros, and a very loose calendar-based guidance as well, March of next year too. That's very different to the open-ended QE at the Federal Reserve. So I say it again, you can call it taper, but Lisa, a taper at the ECB would be very different to the taper that could be announced to the Fed later this year.
How do they signal, though, that they are going to provide support on an ongoing basis to an economy that still has a lot of potential problems? That we do see this inflationary push from higher commodity costs, that doesn't necessarily mean faster growth.
There is an asset purchase program that runs alongside PEP. The degree of flexibility that's carried over from PEP to APP, that's the question. Look, too many details here to get through at the top of the program that we can do a little bit later. Let's start with a price action this Thursday. Going into the ECB decision, we look like this on equity futures. We're down 10, Tom. We're negative 0.2%. We've had 3 days of monster declines whilst you've been out of the building on the S&P. We'll get into that in a moment, TK. Yields in a basis point on the 10-year, down by a basis point to 132.58. And euro-dollar, Lisa, it's a slightly stronger euro going into this decision. Euro-dollar 118.32, that currency pair positive, a little more than 0.1%.
And Tom, you cannot complain that this is not a pretty active day, because frankly, compared to what we've seen over the past 3 days, this is actually pretty active. So you came back to some serious volatility indeed. 7:45 a.m. Eastern time, that is when we're going to get the ECB rate decision. I don't know how much that's actually going to tell us. It really is the 8:30 press conference with Christine Lagarde that everyone is watching. They want to understand the taper. And just to put this in a perspective, take a look at all of the assets on the ECB's balance sheet. More than 8 trillion euros.
On radio, it's appalling.
It's just this real push upward, and the question is not when will it start going down, but when will it start flatlining a little bit more, not going up quite as much. It's the same dilemma over in the United States. Then at 8:30 a.m. in the United States, we get the U.S. jobless claims. The expectation is for 335,000 new claims. Here's the mystery, though, and this is not going to answer the mystery. Yesterday, we got that JOLTS data, the job openings data, a record 10.9 million job openings. Where are the workers? There are more job openings than there are available workers, according to this data. It just does not make sense, and we are not getting any resolution for this. So to the degree that we see a decline in the jobless claims, great. It doesn't really answer this mystery. And then today, President Biden is giving a speech on a 5-pronged plan to try to reduce the cases of COVID in the United States. He's going to be delivering it at 5 p.m. The key thing I want to hear is how much he's looking at the percent of ICU beds occupied by COVID patients. We've seen that really surge back up. How much is this a question of the capacity of the healthcare system versus getting COVID cases down to a much lower position?
John, Tom Porcelli over at RBC talks about JOLTS survey being more important than the pandemic.
What did he say, Tom?
He just said the JOLTS survey was stunning, and the number of people out there starving for labor is off the chart.
I think we're in such a fascinating moment, and I know that you agree. If you look at job openings and quits, it's a labour market that's tight. If you look at the employment to population ratio, this still looks loose relative to pre-pandemic numbers. That is a difficult position for a policymaker to be in.
Yeah, it is as well. You know, to bring in Ben here, John, the drawdown, John, right now is just extraordinary.
It's brutal, right? I mean, down 10.
After the carnage of the last 3 days, the drawdown is just
0.2.
I mean, I'm amazed
1%.
Laidler didn't cancel, frankly.
Ben Laidler joining us now, eToro Global Market Strategist. Ben, I want to start with Bank of America's call. Savita's going to join us a little bit later this morning. She goes to 42.50 by year end. That implies 6% downside. It's an upgrade from 3,800. But let's be clear, the bear is still slightly bearish. Here's the line. Euphoric sentiment, margin risk, record duration pose additional risks. Ben, as a bull, as an equity market bull yourself, what do you say back to that?
Yeah, sentiment's pretty full. Right, but I think if the fundamentals keep delivering, as I think they're going to, and bond yields stay reasonably low, which I think they're going to, I think that gives you that clear roadmap to over 5,000 for next year. You know, I think we're going to get 20% earnings growth next year, which is double consensus. I think that's both top line and margins, and we can get into it. But I think you have very good visibility, you know, on that. And bond yield's going to move up a little bit, but they're going to be a fraction of where they were when we came out of the last couple of recessions. Fed's going to stay, you know, reasonably dovish, I think, to take sort of insurance on this economy is really recovering, and that's going to keep valuations high. Put that together, and I'm very comfortable with over 5,000 for the S&P next year.
Ben, the narratives that are being written are written of caution, maybe not gloom, but caution. How does a bull market happen given caution, not gloom?
Yeah, I think it happens because of caution, right? I mean, this is this wall of worry that, we're now continuing to climb, right? We have some back-to-school nerves, you know, into the market. We've had this sort of remorseless rally since November, which is sort of worrying people. And we have sort of had this trio of sort of, you know, event risk coming out of DC, whether it's, you know, the renomination of Fed Chair Powell or the budget limit or, the debt limit or this, you know, $3 trillion that the Democrats are trying to sort of, you know, ram through Congress. I mean, all that may introduce some noise, introduce some volatility. I think none of that will derail this market. It's really, you know, it's all about the fundamentals. Earnings expectations are still rising. Companies are getting more visibility back, and they're talking about it more. I mean, that's pushing all these earnings numbers up. And at the same time, the Fed is, you know, gradually pushing back, expectations for the taper and for the increase in interest rates. And I think, you know, that's that Goldilocks combination.
When you say the fundamentals, you're talking about the fundamentals of the earnings of specific companies that dominate the S&P 500 in particular, that actually have perhaps fewer employees relative to their overall business. How much is that a feature that you actually celebrate, that you basically want to go into the dominant players in the S&P because perhaps they're a little bit more removed from this stagflationary light environment that we saw out of the Beige Book and out of a whole host of other data?
Yeah, I mean, the stock market's not the economy, and we certainly saw that a lot last year, and we've, you know, enjoyed some of that this year. But I think, you know, look forward, where does the incremental earnings come from? It comes from those reopening stocks. It comes from that, you know, it comes from the sort of real economy, which is underrepresented in the stock market. That's where earnings are, you know, still down 80-90% from sort of pre-pandemic levels. And I think that's what I think you should be focusing on right now. I mean, the sort of growth nerves now, the sort of backward-looking sort of jobs report we had on Friday. I mean, that's a reflection of sort of peak virus cases, but virus cases have been coming down for 3 weeks in a row globally. And potentially peaking now in the US. So I'm actually looking forward to that next step. You know, when are we going to start seeing that growth reacceleration? When are we going to start talking about all these companies that are, you know, not making any money now? When are they going to start, you know, making money? And that delta is going to be enormous. On
seeing the worst of it, Ben, Ellen Zentner of Morgan Stanley would agree with you. Andrew Sheets of Morgan Stanley, underweight US equities, though. He's looking at Europe. You're making this call out of London. Look across the channel to Europe for us. What's the Europe call now for you?
Yeah, I mean, I think Europe actually leads here, right? I mean, you look at who's recovering from this sort of virus third wave best, who has the highest PMIs, growth outlook in the world. It's Europe. Who's best prepared to benefit from that with, you know, the most cyclical indices and the cheapest valuations? It's Europe. And who has the policymakers that are basically going to sit on their hands for an extended period of time and let growth run? I think the ECB may tap the brakes a little bit today, but I think they're going to be one of the last central banks to to actually increase interest rates, and fiscal policy is going to remain pretty loose. So I actually think the next couple of years, European GDP could be on par or even outpace that in the US. And, we've just come off an earnings season in Europe with 140% earnings growth. That tells you, I think, the earnings leverage which you're seeing today.
That is quite a call on GDP in Europe. Ben, great to catch up, sir. Ben Laidler, eToro Global Markets Strategist. He's been bullish, Tom, and he's been right for quite a while.
He has been. And what's so important here is that 1 year, 2 years, 3 years, double-digit return. I think, John, that's the hard thing for people who are absolutely wedded to a single-digit actuarial return. These years after years of double-digit are truly unable to frame it, including we've got at the 7 o'clock hour.
Looking for 5K on the S&P over the next year. Savita Subramanian of Bank of America is not looking for 5K over the next year.
I mean, what do these people
in about 50 minutes
What
time.
do they do? I mean, now is when they have to recalibrate and readjust higher.
We're starting to get the 2022 calls, Tom. Look, Ben Laidler just made a call on the ECB. He said they'll be the last to move on interest rates. Kit Jukes this morning, Tom, asking a question that resonates with me.
Very
I'm sure
funny.
it resonates with both of you too.
Yeah.
Do we get a rate hike in his lifetime? Well, Tom, do we?
No, I think it's a key issue is a timeline, and the x-axis goes out and out. And, I'll let our guests talk about, does that help the NASDAQ? Does it help consumer discretionary? Or what? What I noted, John, on my sabbatical is there was a lot of literature rationalizing a weaker market.
How was that sabbatical? Lisa and I were thinking of you. I know you were exploring retirement at one point.
I was, yeah.
How did that go?
Well, it's good. I went downtown where they've got all the healthcare stuff and looked
Really,
at walkers.
John? Really?
Well, that's what he said to me, Lisa.
I'm really glad that he just kind of plowed right through that.
He messaged me that he was exploring retirement, and he made it to where? You made it to 56.
A lot of people are, which is the reason why a lot of people are out of the labor force.
Yeah, which is, I'm just wondering if Tom
I'm
joins
getting a
in.
jolt
I'd never
here.
want that, TK.
Yeah.
Tom Keene, Lisa Abramowicz, Jonathan Ferro. Look out for the quits
We need
rate.
a countdown clock.
Futures down 12 on the S&P. We're negative 0.25%. This is Bloomberg.
With the first word news, I'm risking up to the European Central Bank is deciding today whether the economy is strong enough to start slowing down monetary stimulus. Policymakers are due to settle on how much bond buying the economy will need in the fourth quarter. Data points to an improving rebound in the euro region, but that's offset in part by the Delta variant and supply chain problems. In Berlin, German prosecutors raided the Finance and Justice Ministries today. It's part of an investigation into whether officials at an anti-money laundering unit failed to handle cases correctly. The case centers on warnings that banks sent the Financial Intelligence Unit about €1 million payment to Africa. In China, inflation levels at the factory level has hit a 13-year high. Producer prices rose 9.5% in August from a year earlier. That was driven mainly by higher prices for commodities. Output prices in the coal industry grew the fastest, up 57% from a year ago. And the Biden administration reportedly is preparing to sue Texas over that controversial new abortion law. That's according to Dow Jones. The Texas law is one of the most restrictive in the nation. A lawsuit would set off a federal-state clash at a time when the future of abortion rights is up in the air. And EasyJet has rejected an unsolicited takeover approach from rival Wizz Air. The British discount airline says the offer was conditional, all stock, and had a low premium. EasyJet now says it plans to raise more than $2 billion as a buffer to see it through a return to vacation travel. Global news 24 hours a day on air on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
When you think about the middle class, the decline, if you will, in the middle class, and you look at the decline in the labor movement, they run parallel to each other. And I think if we truly want to have a society where we build a middle class, a true middle class, where enough Americans can get into the middle class, we're going to have to see an increase in the labor movement.
That was Marty Walsh there, the U.S. Secretary of Labor from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Here's the price action this Thursday morning, going into an ECB decision 1 hour and about 30 minutes away. Looking at the bond market, yields in by a basis point to 132.75. The euro just a little bit stronger. Euro dollar 118.32, positive by a little more than 0.1%. Futures just soggy, softer, lower, negative 11 on the S&P. We're down about 0.25% on the S&P 500, adding to just a little bit bit of the weakness, Tom, over the previous 3 days.
Yeah, Sagi really captures it nicely. The VIX from a 16 level. We had a 19.6 level. We're now 18.97. Let's round that up to 19 even to show the modest angst before the ECB meeting. Jets Fitzpatrick is with us with Bloomberg Government in Washington. Jack, it's a $3.5 million wish list for Senator Sanders and others. I'm seeing $1 trillion will be maybe the workable number as well. When the House goes in and pares this bill down, do they do it at the margin of each program on their wish list, or do they eliminate programs? Which is it?
Well, first, this is probably going to get pared down by the Senate. We're starting to see House markups that are pretty much in line with this $3.5 trillion measure. So it may be the case that there's a little bit of a game of ping pong where the House does something, the Senate changes, sends it back. It may be necessary to lop off significant parts of this $3.5 trillion series of proposals if we do have to watch the Democrats take this down to something like $1 trillion, $1.5 trillion. But that's going to depend on how much money they're told by the Congressional Budget Office they can raise through their tax raising measurements and those proposals. So we're kind of going to have to wait until the end to see exactly how significant those issues are. So it's going to take a little bit. It's probably going to be the Senate that cuts things off. But when it does come time to trim this down, it's probably going to be more a matter of pulling large portions out of it if it is really that significant.
Can they pass this legislation without the tax increase support?
They could pass whatever they want on partisan lines if they decide they don't want to pay for it. But the president has said repeatedly, and I believe Jen Psaki just said, I think yesterday, this is supposed to be fully paid for. Some Democrats don't want it to necessarily be fully paid for, but according to the instructions that they agreed to for the reconciliation process, the limit on how much they could deficit finance would be about $1.7 trillion. That's a lot of money. But really, it comes down to willpower. They could raise taxes enough to fully pay for it, or they could deficit finance it. That really depends probably on Joe Manchin and Kyrsten Sinema more than anybody else, though.
Jack, the Federal Reserve is considered a nonpartisan group. The Treasury Department is potentially quite partisan, and we're seeing Janet Yellen now in her new position, not that new anymore, as the Treasury Secretary, really coming out in a more political posture. How is she being evaluated by people in terms of how well she's pushing forward this plan?
She's in a difficult position for a couple of reasons. One, you saw the recent Treasury report outlining how much additional revenue they think the government could raise by enforcing existing tax laws. Those numbers, which total maybe up to $7 trillion over the course of a decade, are much, much greater than what you've seen from Congress's own Congressional Budget Office. So there's a huge gap there. With the CBO says they can only actually raise about $120 billion over the course of 10 years by enforcing existing laws. The other thing that's really tough on Secretary Yellen's plate is trying to get Congress moving on the debt limit.
Right.
She just warned them they'd probably only have until sometime in October to act on that.
Jack, I was going to go there next, and I want you to talk about not only what she did and how she's trying to push them, but what tools she could potentially use to forestall the debt ceiling limit that she does not seem willing to use.
Well, they are using extraordinary measures. I'm not sure if there's, when I talk to lawmakers and from Congress's perspective, I think there's some satisfaction that Treasury is putting this off to a significant degree. The original deadline was August 1st. Now they're saying it's going to be something like October. But the issue between Yellen and Capitol Hill really has been that she has said for a while, you need to get this done as soon as possible. She warned this could actually be an effective deadline as early as sometime in August. Those early warnings were largely ignored, and Congress is slow walking it a bit. And so she has not really been successful in getting quick, early action from lawmakers on the debt limit.
Jack, give us an update on the refugees that we saw at Dulles, just as a final moment to catch up here midway through the week here. They landed at Dulles. Where did they go?
There are a variety of locations that the Afghan refugees are going throughout the U.S. There are going to be some in the D.C. area. So I can't speak exactly to the ones who landed in Dulles. One issue that lawmakers are facing is how much support they give those refugees, how much funding they apply to that. That's going to be debated in the near future. Biden requested $6.4 billion more for removing people and processing them from Afghanistan. So that's the broader issue is going to continue to be debated because this has been a bit more difficult and expensive than anybody initially realized. But it's more or less a variety of cities throughout the country. I want to say a dozen or so as a ballpark, different areas where there's initially placed in the U.S.
Jack, good to catch up. As always, Jack Fitzpatrick down in D.C., our Bloomberg government reporter. Tom, you just get the feeling, and I get that feeling every single morning now as we talk to people down in Washington, that the brakes have just been slammed on this agenda over the last several months.
Yep, not only the agenda, but many different parts of the agenda as well. I totally agree. We're back from August. We're into September. And, yes, Senator Manchin's front and center here is someone that can slam on the brakes. But, John, I think it's in too many different issues, including the pandemic.
Yeah, Lisa, hard to see where we're making progress at the moment.
And the question is the risk, right? I mean, how much risk really is there and what's actually been priced into markets? Has the $3.5 trillion plan been priced into markets? Probably not, although people think that it's going to be offset by higher taxes. But this is why people are all citing policy disagreements or uncertainty as the reason for the hoped-for sell-off.
Morgan Stanley, one of them. Look, this is the reason I've been asking a question, Tom, over the last couple of days. Would you be more surprised by getting something done down in D.C. or not getting anything done at all? What would this market be more surprised by at this point?
Don't know. I think, John, the basic idea here is this is absolutely original, the linkage of infrastructure into massive social spending. And because it's original, we don't know.
Equity futures this morning, we're negative 11. We're down about 0.25% on the S&P 500.
Prime Minister Johnson's tax policy.
ECB meeting decision, 1 hour, 20 minutes away. We can discuss that in the break. Yes, Tom.
Yeah, Crystal Palace thoughts too.
Looking forward to that too. From New York, it's good to have you back on radio and TV. This is Bloomberg.
I'm worried about Crystal Palace.
Live from New York City for our audience worldwide on TV and radio. Here's the price action this Thursday morning, about 15 minutes away from that ECB decision. Equity futures this morning down about 10, 11 points with negative 0.2%, coming off the back of 3 really mild marginal days of losses on the S&P. The Nasdaq down 0.2. The Russell, the small caps, in a bit of trouble the last couple of days. We're negative 0.4% there. On the S&P 500, a close above 4,500 yesterday. Look out for 4,250. That's the year-end price target of Bank of America, Savita Subramaniam. It's a little bit of an upgrade from 3,800. That was their previous year-end price target. Savita is going to join us in about 30 minutes' time. Really looking forward to that conversation. Yep. That's the equity picture. Tom, here's the bond market picture. 2s, 10s and 30s in the Treasury market. 2s unchanged at about 21, 22 basis points. Out to 10s, 132.58. Yields in about a basis point. 30s in about a basis point, 194.26. HSBC Steve Major speaking a little bit earlier this morning.
Yeah, I saw that.
He'd be surprised if we got a hike in 2023. That man, as you well know, is looking for a move down towards 1% year-end, something closer to 1% than where we're at right now at 132.58. Let's finish on this. As we work our way through to the ECB, it is the German-Italian 10-year spread. Over the last 5 years, the average is about 175 basis points. That's Italy trading over Germany, of course. Right now, a little north of 100 basis points. Last year in the spring pandemic, what were we talking about? 270, 280, pushing 300. And this ECB came out early, didn't it? President Lagarde, Tom, what did she say? We're not here to close spreads. What did she do? She closed spreads. So today, we're talking about the potential for a reduction in the pace of purchases. What we are not discussing, what the ECB will not be ready to discuss, is about a reduction in accommodation over a series of years, because we have 2 programs here, Tom. We have the Pandemic Emergency Purchase Program, which has an envelope, a package size of 1.85 trillion, which is set to run through to March next year. You can discuss the pace and whether we use all of that. And then you have the asset purchase program, which runs alongside it, which may well be boosted next year, dependent on what the forecast will be. So it's the forecast, Tom, you need to look for at about 8:30 Eastern.
Was Lionel Messi an asset purchase program for PSG?
You want to go there?
Well, I don't know.
I mean, right now,
evidently.
You want to talk football?
You're in the weeds here on ECB.
We can do random. That sounds pretty random to me. Tom, I just want to finish on this. From the market's perspective, this is the North Star for the ECB, not the inflation target.
And that shows us,
it's that spread.
Yeah, stronger Italy.
We can do football now if you want.
About that.
No,
we don't need to do football.
No? You want to move on?
Peter Hooper with us with Deutsche Bank, and really thrilled he could be with us because they're doing some really original research. I'm going to touch on that right now. I'm sure John will swing it around to the ECB. Dr. Hooper, your Matt Luzetti's done fabulous work on the reservation wage, which is the spirit of workers to say, no, if I'm not paid this amount, I'm not working. How has this pandemic affected the behavior of labor to demand a certain wage?
Well, Tom, Matt and team have picked up on some really nice data that the New York Fed has put out on the survey of consumers. The reservation wage, the amount that you're willing to accept to take a new job, went up substantially over the last year. Certainly, pandemic discouraging people from wanting to get into work. But what we've seen in the latest data, the latest observation coming out yesterday through July, is a decline. So reservation wages coming back down, people looking more willing to get into work. Some of that, I think, is perhaps anticipating that support, unemployment benefits, are going to be coming off, as well as maybe. In some parts of the country, certainly vaccination picking up enough to make it a little more attractive.
What is Deutsche Bank doing with your GDP analysis? We're a little bored today, Peter. We need to make some news here. Can you give us a U.S. GDP markdown so we can have a perky Thursday?
Matt and team have certainly taken some steam out of growth prospects for the second half of the year. They reported over the weekend that they're marking down their forecast for the second half from something above 7% to certainly down below 6%. So something enough to take about a 0.5 percentage point out of growth for the year as a whole. Now this is partly something that's going to be sustained because consumer activity is looking just a little weaker, given what's happening around Delta. Given anticipation of what's going to happen as unemployment benefits run off. They've done some good work looking across counties and seeing that counties that ran their unemployment benefits down earlier have seen bigger drops in consumption. But it's also related to the degree to which Delta has hit various parts of the country. Some of that drop-off will be coming back next year. Certainly, supply chain disruptions are a major factor. What's been happening in inventories, that will be coming back. So some of this weakening of growth this year, and this is speaking relatively. We're talking about weakening from a phenomenally high rate of growth to something that's not quite as high.
Pete, I think that's what frustrates people. We're talking about 4 next year instead of 5 or 6, and you get people talking about stagflation. I want your view on the labour market, Peter. Is this labour market loose or is this labour market tight?
This labour market is certainly very tight in some areas. I mean, no question that mismatches are near an all-time high. As many firms, I mean, the number of openings, job openings, relative to unemployed people available to fill them is that ratio is probably as high as we've seen in many decades. Some of this, of course, because people have left the labor force. People have left because of discouragement over COVID and now Delta. People have left because of the unavailability of daycare and schools being open. We do expect to see that improve as the fall goes on. We're expecting to see certainly better numbers in September than we had in August on payrolls, and that should improve over time. Yes, no question, there's some near-term substantial tightness that we think will begin to resolve itself over time.
Peter, it begs the question, though, whether the employment to population ratio should be on the Fed's dashboard and whether they should be comparing it to where we were pre-pandemic, whether that should be their so-called North Star at the moment. Do you think it should be?
Certainly, the employment population ratio is a better indicator at a time when you have all this departure from the labor force and uncertainty about how much return you're going to get. Yes, and I think they, in all fairness, they have a pretty wide dashboard, and that's certainly one of the variables that they look at. Certainly in light of the questions about unemployment as a guide in a time when labor force participation is moving all over the place.
Peter, there's also this issue of raising rates, and you say you don't expect the Fed to actually start raising rates until the third quarter of 2023. We heard about it from HSBC's Stephen Major, that that's the very earliest he could imagine, and perhaps that's even too early. Do you think that the Federal Reserve will have the bandwidth to even raise rates, given the fact that at that point, who knows where the economic cycle will be, and they might have to be starting to think about perhaps more accommodation?
Well, Lisa, a lot is going to depend on do we get this drop back in inflation that everybody's anticipating here? Yes, our house call, our Matt and team certainly have been very much on the ball here with the thought that we are seeing transitory surge in inflation. That is going to be coming off. And there's still a lot of unemployed people to bring back into the labor force so that these near-term shortages are going to be resolved. But there's certainly risk out there, and at the beginning of the year, if you told me the CPI inflation was going to be running well above 5% through much of the year, I would have said, look, the Fed's going to have to be much more cautious about letting this get away. These are decisions that are coming down the road, depending on how this thing unfolds. There are upside risks to inflation that certainly say the Fed may have to act sooner. But at this point, I'll take Matt and team's call as the most likely outcome. Yes.
Pete, good to catch up. Peter Hooper there, Deutsche Bank Securities Global Head of Economic Research. Some headlines coming out of United Airlines in the last 60 minutes or so. Here they are, on track to meet guidance for 3Q. Take a look at 4Q. Also now expecting an adjusted pre-tax loss in the fourth quarter over United Airlines. And Tom, it won't be a surprise to hear the following headline. They've seen a deceleration in customer bookings in the last few weeks, and they're going to have to do something about matching capacity to that demand that has decelerated going into year end.
It goes back to what Lisa said, standing at the wall there on hospitalizations. I mean, this is where we are. This is the math, and we're seeing it not only in pandemic industries like United Airlines, but frankly, all over the economy as well. I mean, what is the tone right now, John? Is it a 4% economy, a 3% economy? We don't know until we see the data, but it's not a boom economy anymore.
Next year consensus has a 4 handle.
Yeah.
For these airlines, look, Ellen Zentner of Morgan Stanley has made the point, we mentioned it in the previous hour, Tom, in the last hour, that August might have been the worst of it for the data, for the pandemic. Maybe we've seen the peak and we can move on from here. And I think for markets, bear in mind the airlines, that sector, topped out in spring. And it's been pretty rough since then. Some of those names are down 20% since then. So the question you've got to ask yourself in the market, do these kind of data points, these kind of headlines reinforce a move we've already seen, or at least set us up for more pain down the road?
And a lot of this does have to do with the airlines, specifically of business travel, and how many conferences have been canceled, and how sustainable is their balance sheet to persist for another 6 months, 12 months without regaining some of the volume that they saw pre-pandemic.
We certainly heard that from Ed Bastian over at Delta in the last couple of days. In your equity market, what are we down, 11 on the S&P?
Serious stuff.
It's a mild morning, isn't it? We're down about 0.25% on the S&P, maybe a fourth day of losses. Into the bond market, yields in a basis point at 132.58, and about an hour and 4 minutes away from an ECB decision. Euro dollar 118.33. We're positive on that currency pair, a little more than 0.1%. From New York, this is Bloomberg.
With the first word news, I'm Rishika Gupta. Corporate vaccine policies show a stark divide over employer mandates. Bloomberg surveyed more than 100 big companies About half have implemented a vaccine mandate for at least some of their U.S. staff. Still, requirements vary widely, and the planned post-Labor Day migration back to American offices isn't happening as planned. For the first time, U.S. antitrust officials have made public the data they're using to help prove Facebook has a monopoly over social networking. The FTC revealed numbers that it says show Facebook is far and away the most dominant social network. The company has said that the case is without merit. And a new study says inequality in unemployment, education, and earnings has cost the U.S. economy almost $23 trillion over the past 30 years. And that figure is likely to rise as minority populations increase. The paper came from a group of economists, including San Francisco Fed President Mary Daly. Hordes of meme stock investors were waiting for good news from GameStop, and you know what? They still are. The struggling video game retailer posted a bigger than expected second quarter loss and took no questions on a call with analysts. GameStop has yet to reveal details of its turnaround strategy. More than half the young employees in the UK say working from home has hurt their office conversation skills. That could potentially harm their career prospects and pay. The survey from LinkedIn also found that 84% of those polled felt out of practice when it comes to office life. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rich Gupta. This is Bloomberg.
It did make sense earlier in the pandemic to give us time to prepare, to do surge preparedness, to identify testing strategies. I'm not sure if it does make sense anymore, especially when there is so much other travel happening around the world.
Bhakti Hansati there, Johns Hopkins Associate Professor of Emergency Medicine on travel bans around the world. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Here's your equity market, a price action. We're down 12. We're negative a third of 1% on the S&P off the back of about 3 days of losses. Really marginal days of losses, including what was Friday, negative 0.03%. Something like
huge,
that.
Massive.
I know, Tom, huge. Yields in a massive single basis point to 132.24. And euro dollar going into that ECB decision a little less than an hour away now. Euro dollar 118.32, positive there, a little more than a tenth of 1%. TK, have you seen the rents in New York City? Here's some data for you. Miller Samuel and brokerage Douglas Elliman putting these numbers together for us. 8.1% in August year over year if you have a doorman. If you do not have a doorman, the rents for those units fell 12% year over year in the month of August. So if you have a doorman, we're up 8. If you don't, we're down 12. What do you reckon that's about, TK?
I don't know. You know, the walk-up that I'm in, I really don't worry about it. But, John, I do think, and as I watch rents, the vacancies are gone.
Walk down.
They're just absolutely
given
gone.
what happened with his elevator last week, it was a walk down.
Not a walk-up. You know, the bottom line is rents are going up. That's all there is to it, John. And what I like about your numbers there, John, I don't think it's 2 or 3% lift. I think it's much more, and it really buttresses up against wage growth.
Well, if you have, Tom, do you think post-pandemic that you want the doorman because of deliveries, things like that? The convenience of it, the need to have it is that much greater now in the last year.
Yeah, I think so.
Security too, do you think that speaks to that as well?
And the bottom line is everything.
I don't know. I live in a walk-up in Murray Hill, Tom.
I know you do.
You're in a fancy
Lisa's
town with a
the only one who's
doorman.
got the fancy thing going.
I'm looking forward to the NFL and the sports bars this weekend.
Jennifer Nuzzo's going, what in God's name are they talking about?
She's not alone.
Joining us with Johns Hopkins Center for Health Security and to save us, Jennifer Nuzzo this morning. Jennifer, there is a reaffirmation that the pandemic is still with us. I was explaining to one of the offspring, it's like the 28th chapter of the plague, Albert Camus' wonderful book, where it just won't go away. How should we deal with this pandemic exhaustion?
Yeah, I mean, it is really exhausting, I have to say. Even, someone who lives in the data and sees every day why we remain concerned about it. It's exhausting and people want to get back to living their lives. I completely understand that. I think we're getting closer. And the thing that we need to do, I say this every time I come on, but the thing we need to do to get closer to that end is to get vaccinated. There's still a lot of progress to be made on that front. We still have a lot of adults who are unprotected. We know that vaccinating adults protects kids. And then, there's still kids.
Jen, look, you're like one of the leaders in the nation on health security. What do we do to the unvaccinated? What is your policy prescription to provide incentives to the unvaccinated?
Well, I think the thing that's probably going to have the biggest impact is what's been going on. And businesses are rightly wanting to get back to business. They want to do so safely. They realize that their employees want to come back, their customers want to come back, and that the best way to make sure that happens safely and happens without further interruption is to require that their employees get vaccinated. Now that the vaccine is approved, at least we have one vaccine formally approved, I think it makes it easier for businesses to make that decision. And I think that's going to have a big impact in terms of vaccine uptake.
Dr. Nuzzo, John Ferro opened up this conversation talking about rents in New York City. It raises a question about the fate of big cities in an era where people are more concerned about variants of COVID that are never going to go away. Do you foresee a time when people will not be wearing masks and people will be operating the way that they did pre-2020 again in the next 5 years, or is that a pipe dream at this point?
Oh, I don't think it's a pipe dream. I mean, I very much foresee that. I mean, first of all, I think people are tired and they're not going to do it. And I think, we're getting closer to that point. I mean, one of the biggest things that vaccines do is they decouple the cases that we see from the deaths. And once we're no longer acutely worried about hospital systems being overwhelmed or people winding up severely ill or dying from this virus, I think the calculus of whether or not people need to wear masks changes. And I think that's going to happen sooner than we think.
Dr. Nuzzo, President Biden's going to be speaking at 5 p.m. today, giving a COVID speech, laying out 5 points of how we merge to the next phase of perhaps putting this behind us. What do you hope he says? What hasn't he said that's important?
Well, one of the things I'm deeply worried about is the erosion of testing capacities in the United States. We wrote an op-ed in the Times in March calling for this. So it's been many months. We saw that it was getting much, much harder to get tested. And while it was understandable, states had to kind of pivot from offering tests to offering vaccines. Tests were always going to remain important. And it shouldn't be hard for people to get tested, particularly if they have symptoms. They shouldn't have to spend hours, and they shouldn't have to wait. They shouldn't spend hours trying to find a place, and they shouldn't have to wait days to get their test results back. We haven't done enough with rapid testing. People want to be able to test themselves in their home, but they shouldn't have to pay a hefty price in order to do that. It should be freely and easily available. So that's what I'm going to be looking for. I also want to hear a strategy for how we're going to make sure everyone who needs to get vaccinated can. There's been a lot of confusion now about boosters, and what I'm worried about is that all the people who have great protection already are the ones who are going to be running out and getting more vaccines, as opposed to focusing on getting first and second doses into people's arms. That's what's going to get us out of this pandemic more so than third doses.
Jen, always good to catch up with you. Thanks for being with us. Jennifer Nuzzo there, Johns Hopkins Center for House Security, senior scholar. I was looking at the Excelsior Pass. Here in New York State, if you've been vaccinated here, there's a pass on your phone. You can download it, readily available to everybody here. Lisa, mine expires on the 16th of October. The 16th of October?
Yeah.
What's meant to happen on the 16th of October?
How would I know? I mean, that's
when
the
does
thing.
yours expire? I think a lot of people.
I'll check. You have to give me a minute, and I don't think anyone wants to.
TK, when does yours expire?
February 12th, Lincoln's birthday.
So why are you February 12th and mine's October?
Mine is April 2022.
I have no
So you're
idea.
April?
Yeah, mine, I have a long...
That makes no sense at all.
Maybe it's because, you're British. Maybe
You
it's discrimination.
You think so?
No, I don't.
But seriously, John, I'm out of touch on this, John. Let's cut to the chase. If you leave America now, John, and go to Heathrow, can you come back?
No, I've got to fly through Mexico or Turkey, Tom.
Okay,
Spend 2
I'll
weeks
ask the
there.
surveillance question. Why?
Don't know.
I just don't get it.
I mean, I've asked the administration, Tom, and they'll tell you science, and then you ask the scientists, and they'll kind of shrug their shoulders a little bit.
I'm baffled by the whole thing. I mean,
I'm not sure if you want me to get fired up about that one.
Like, we're 97% vaccinated.
Trying to tweak you on that.
Everybody's wearing masks, and Greg Vallier's got, like, Florida's 54% vaccinated.
TK, you can go to the UK and fly back.
I can.
You've got a different colour passport, which means COVID won't touch you when you come back to New York. It can't get you. Science. You want to keep this going? Futures down 12 on the S&P. We're negative a third of 1%.
The markets.
I could go so much harder on this. Yields in a basis point on a 10-year, 132.
He just doesn't want to talk
58.
Crystal Palace ties.
You really want to go there, don't you?
It's a big deal. I mean, Ted Lasso's filmed at their
At Selhurst
stadium.
Park.
Yeah.
Euro dollar, 118.31.
Bottling this up for 3 days.
Whatever it's called. 15 minutes away from an ECB decision. Tom thinks this morning is boring. He's been away the last couple of days.
No, it's
Tom,
like
that was boring. Believe me.
You're ramping up the ECB. It's a snooze fest.
I had fun.
Did
Maybe
you?
I was alone.
Really? From New York, this is Bloomberg.
The story is going to flip in terms of profitability and inflation.
This is not a market of everything is going to go up, everything is going to win.
We're in a very low risk environment, and the feeling is you can buy practically anything.
When we look at consumer finances in general, there's still potential for the consumer to spend over time.
I think all those things point to an economic cycle that lasts just a bit longer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The ECB decides this hour from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market down 12. We're negative a third of 1% on the S&P. TK, 4 days of losses on the cards. A monster move.
It's been a monster drawdown. We showed that last hour as well. I love that we had Ben Laidler optimistic, John Douglas Cass watching. Good morning, Doug Cass. He's very cautious on the market. He looks for a market hurricane.
A hurricane. A hurricane. I don't know if the sarcasm didn't translate or not over Bloomberg Radio. They've been really marginal moves Friday, Tuesday, Wednesday into Thursday. Tom, in about 45 minutes, the ECB joins in.
Yeah, you know, we've been making jokes about it, but to be honest, everybody's going to hang on every word of the press conference. I mean, the statement, you tell me, John, maybe it's in the margin. You're expert on it. I could care less. But the press conference may have some real value. She's got to change the dialogue in what way?
So at 45 minutes past the hour, we should get some understanding about the pace of purchases. Then at 30 minutes past the next hour, it's the news conference. And at the start of that news conference, Tom, you will get some forecasts. So the forecast could be interesting just in terms of what they do with their outlook for inflation.
We just had Jennifer Newsawan, Johns Hopkins University, has an American conversation. The pandemic's no different over there. She's got to be pandemic affected.
So that's the story for the Pandemic Emergency Purchase Program. And the key here, Tom, is the E in PEP. It's emergency. Are we still in the emergency phase of all of this? Do we still need the program that big with that much flexibility in a moment like the one we're in right now? And Tom, I think that's the conversation they'll have within the Governing Council and no doubt in the news conference with journalists.
But I mean, Lister Man City this weekend, I mean, they're going to have 30,000 people in the stands,
You had to get there, didn't you?
No, but is that an emergency pandemic
It doesn't look
program?
like an emergency if the stadium's full in the UK.
I just don't get it. I'm lost.
Lisa,
in the
many
whole
people
thing.
don't get it. Are we still in the emergency phase of this pandemic? Can you justify the flexibility that program has?
I was in a restaurant last night, Lisa, over by you, and there's no emergency.
Well, perhaps not in a restaurant in New York City. The question is, what's the nature of the emergency? And right now, we're not just dealing with the pandemic of numbers. And in Europe, actually, I think that they've exceeded the U.S. when it comes to vaccinations at this point. But it also has to do with some of the supply chain kinks that are causing inflation to pick up and sort of the mismatches that you're seeing over there in the labor market as well. How do they bring it back? And what does the central bank, the ECB, actually do about that? How much does this PEP program really help that?
Lisa, did you see PPI? In China,
Yeah.
factory gate prices just absolutely surging.
The highest since 2013 years, I should say. And this really stems from the fact that aluminum is the highest that it's been in 13 years. You're seeing surging metal prices, and even though you've got authorities trying to tamp them down, it isn't working. And this does lead to, I hate to use the S word, but I mean, a stagflationary kind of feeling. Even if you get growth of 4%, 5%, it's not necessarily the acceleration that will sustain that over a longer term.
Aluminum. Aluminium, I'm still practicing.
But it
Futures
doesn't
down
have
12.
EM at
Thanks,
the
Tom.
end.
Lisa missed it. We're
No.
down 12 on the S&P.
I didn't
We're off
miss
by
it.
a quarter of 1% in the bond market. Yields in a basis point. 132.58 on 10s this morning. Your ECB decision is 42 minutes away. Euro dollar 118.29. Lisa, that currency pair positive. A little more than 1/10%.
Yeah, and as you've been saying all morning, in 42 minutes, we get the ECB rate decision, which, of course, I'm watching. That rate decision will be the interesting part, but even more interesting is the 8:30 a.m. Christine Lagarde press conference. Very interested to hear how they talk about their balance sheet as a tool going forward. More than 8 trillion euros currently, all assets under the ECB's balance sheet. People expect the U.S. to continue and actually use the balance sheet even more going forward as a tool because we have such low rates rates. Does the ECB have the same capacity to do this, given some of the split politics of a continent that is not one united nation? Then at 8:30 a.m., we get U.S. initial jobless claims. The expectation is for 335,000 new jobless claims. Again, how much does this point to dynamism in the economy at a time when the job openings have surged to nearly 11 million, a record, an all-time high? Why does this persist? Why are there any layoffs at this point? Is this the quit rate going up as people see more flexibility and options, especially with their savings flush from some of the rounds of stimulus checks? And then at 5 p.m. tonight, President Biden's going to give a speech about COVID, laying out a 5-point plan, trying to discuss how to get to the next stage where we stop wearing masks and can actually re-engage with society in the way that we used to know it, John.
Lisa, thank you. Let's start right here with a story that developed in the last 24 hours. The title of the research, Should You Keep Dancing If the Music Slows Down? It was Bank of America, and here are the numbers. We mark S&P 500 21 target of 4250 by year end. That implies 6% downside from here, and launch 22 year end target at 4600, just plus 2% from here. This price target move to 4250 was from 3800 previously. Here's the line. Euphoric sentiment, margin risk, record duration pose additional risk. Own what's scarce, inflation-protected yield. I'm pleased to say that leading that team is Savita Subramanian of Bank of America, the head of U.S. equity and quantitative strategy, and she joins us right now. Savita, I'm interested in the process. You go from 3,800 to 4,250. Some people might call that capitulation. I'm not sure I'm in that camp. Just walk me through your approach to this market, to your forecast, with other people throwing out numbers like 5K for next year.
Sure. Yeah. The process is it's a disciplined process. So we have five signals that we look at, which range from things like sentiment to fair value, valuations, earnings revisions. Here's what's happened over the last few months. Earnings have come in much better than expected, and the market has basically doubled off of the COVID lows. So essentially, a lot of what we've done in terms of thinking about our target from here is how much good news is priced into the market, how much more can the market rise from these levels, or is there downside risk in the months to come? And I think that, part of what we're looking at is the idea that the market is essentially, the valuations of the market right now are leaving very little margin for error. Meanwhile, earnings have come in strong, but we're starting to see some harbingers of risk. And, everybody's talking about supply chain risk and inflation. We're actually starting to see that come in the numbers. So every month we track this guidance ratio. We look at the number of companies that are guiding above versus below consensus earnings revisions or consensus earnings estimates. Over the last, let's call it 4 weeks, we've seen that guidance ratio move from record highs to a big southward move. We're starting to see companies warn on profits, and it's showing up in a broader way across the S&P 500. So first of all, earnings are at risk from just a cyclical pressure of input costs, wages, supply chain dislocation, et cetera. Second of all, when you look at the secular pressures on margins, we've had this great period of time for the S&P 500 of globalization. The past 20, 30 years have been about U.S. companies getting more global, kind of arbitraging taxes, labor costs, et cetera. Now look what's happening. We're at peak globalization. We're starting to see companies onshore. And what that's going to do is, again, potentially stall or reverse this kind of long-term great theme that we've had for big multinationals in the S&P.
Savita, I want to pin you down on this. Partition for me the earnings dynamic, the nugget that we call earnings growth, the dollar amount of earnings of S&P index versus the partial differentials of price to earnings. Which of those dynamics are you focusing on with such a narrow call?
Well, I think it's more the PE that's making us think, okay, there's not a lot of upside from here. And I'll tell you one thing, Tom. So we have a valuation framework that's not very predictive over the near term, but it's kind of all that matters over the long term. The R squared on this framework is 80% in terms of explaining.
But this is critical. I don't mean to interrupt, but this, folks, is math that's important. Is your R squared valid given the dominance of those gigatech companies?
Well, I'll tell you this much. It worked during the tech bubble. And this is an important point. I'm glad you brought up the gigatech tech companies, because the last time this framework was as negative as it is today was in 1999, another period where we were all kind of calling out the primacy of technology. And I think that today the bubble is potentially even more dangerous because it's not about, growth stocks, where tech ultimately grew into its multiples. It's about bonds and interest rates remaining as low as they are for perpetuity. I mean, this is what scares me, Tom, is that the S&P 500 has essentially turned into a 36-year zero coupon bond. If you look at the duration of the market today, it's basically longer duration than it's ever been. So what that means is that any move higher in the cost of capital, be it interest rates, credit spreads, equity risk premia, that's basically going to be a huge knock on the market relative to the sensitivity we've seen in the past.
Savita, just real quickly here, you did upgrade your forecast, however. You moved up from 3,800. Why does this not become the bear case that you originally saw?
Well, look, I mean, I think that the market could move as low as 3,800 in the near term. But when we look at our frameworks and we think about, okay, points in time forecasts are fraught with peril. But I think, our view is, okay, earnings have come in a little bit better. Companies have been able to navigate a lot of the margin pressures. We're actually at peak margins today for S&P. So it's a pretty remarkable story that corporate America has been able to manage, the COVID-related risks as well as it has. But I think that now we're starting to see some of those areas fray, and we're sort of waiting to see how corporate America deals with it. What would make me more bearish and go back to 3,800 is if we see inflation persistent and dangerous and companies unable to pass any of it on through prices, and if we saw a more hawkish Fed. I think the other thing that we pointed out in our note is that earnings matter for the market, but post-crisis, what matters even more is the Fed. And I think, it's kind of remarkable. We have a chart in our note that shows that the Fed has basically explained half of the market moves outside of earnings since the global financial crisis. So you've got this market that's basically been fed by stimulus. We're now at a point where the Fed is talking about tapering. It's hard to imagine they're going to accelerate asset purchases. I mean, what gives? And, the valuations don't reflect any of this risk. So I think that,
I've only got 60 seconds left on the clock, but I don't want to leave you before asking, what do you want to own right now within this equity market, away from the index level stuff?
There's always a bull market somewhere, and what you want to own is the key scarce theme today, which is inflation-protected yield. So let's say the Fed keeps rates low forever, but inflation is starting to bubble up. Don't buy bonds. Bonds offer you a fixed coupon that's not going to keep up with inflation. Buy energy dividend yielders, by financials dividend yielders, by companies that are positively tethered to inflation and can pay a growing yield. I think that's the call right now is really focus on income and inflation protection.
Savita, this was great. Can you promise me one thing? Next time you come back, let's get you together with Jonathan Goliver, Credit Suisse again, and we can do a repeat. Let's do a repeat of that. Savita, it's good to catch up. We appreciate your time as always. Send our regards to the team. Savita Subramanian of Bank of America. Lisa, you say we just sit back. Believe me, the last time I did that, I did just sit back.
I know.
I
just
let them go.
Great job, and it was fantastic. And honestly, it's great to get both sides of the case because, frankly, this is the debate being had on Wall Street right now.
And Tom, away from the index level discussion, which is stunning to hear from Bank of America right now, there is a call within that to get long certain aspects of this market.
It's an absolutely original call, which speaks to how original the times are.
Very, very original. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Equity futures down 11. We're negative 0.25%. Heard on radio, seen on TV. This is Bloomberg Surveillance.
I think it's unlikely that the Fed is going to hike anytime soon. And in fact, I would even argue that 2023 is too soon. But if they were to hike, are we ready for what's going to happen? What happens to asset prices? And the feedback loop, therefore, into policy. So we are a bit stuck in a debt trap. And that's been informing our forecasts for a long time.
A punchy Steve Major, always punchy. Steve Major, HSBC's global head of fixed income research from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Here's the price action in the equity market about 20 minutes out from that ECB decision. Let's call it 30. Your equity market down 11. We're negative 0.25% on the S&P. That's been a story the last couple of days. 3 days of losses, but really marginal moves. In the bond market, yields lower by about a basis point to 133. TK, let's call it 133, 132.75.
John, if we get a 133 and Steve Major's saying 1%, you've been framing out 112. What's the ramification to the market if we get to 120? Is it good or bad for stocks?
Why do we get there? That's the question, isn't it? Why do we get down to those kind of levels? It's what drives us to those levels that ultimately matters. And to use Steve Major's framework for this market right now, Tom, our tolerance for higher yields has gone down because we've added so much more debt to the system, on both the corporate side, on the sovereign side as well, around the world. So your tolerance for higher interest rates diminishes almost every cycle. We've played this game before. We've seen this movie before. We saw it in the last cycle as well. So the peak for interest rates, Tom, is that little bit lower this time around as well for the Fed funds rate. And in his opinion, he's making the argument, Tom, that maybe you don't get that first move over at the Federal Reserve for a long, long time, maybe several more years.
Well, it's always good to hear from Mr. Major over in Asia now with HSBC. Josh Wingrove now is at 1600 Pennsylvania, our Bloomberg White House reporter. Thrilled he could step in this morning. Josh, we're going to get to 5 p.m. today. I want to cut to the chase. The White House and the unvaccinated. What can the White House, what can the president do unilaterally to affect, motivate, harm the unvaccinated?
Well, I don't know that he's looking to harm the unvaccinated necessarily, but he's running out of tools in the toolkit, that's for sure. We're going to see that big speech tonight. They're saying 6 planks of his so-called new strategy to quell the pandemic. Of course, they thought they'd quelled it. So what they kind of hinted at, and this is absolutely not confirmed, is that maybe they're going to expand vaccine mandates. That would probably be for federal workers, where Biden has the power to do that. They confirmed that their opinion hasn't changed, that they don't actually have the power to impose sort of widespread national vaccine mandates of any kind. What they've said is that these sort of they're hitting singles instead of home runs. These little incentives, whether it's an employer requiring it or a sports venue requiring it, et cetera, have been driving vaccination rates, and I think that's where they're going to hope to be.
And Lisa, just to explain that to you, that's what the Mets do. They hit singles and not home runs.
And they don't hit any home runs, and that's why we end the season the way that we do. Josh, what kind of political support is he going to draw from Republicans, since a lot of the regions that are lagging behind with vaccinations tend to be red states, not blue states?
Yeah, I mean, it depends on the Republicans. Some Republican governors have been pretty out there in terms of calling for public health measures. Others have been obviously pushing against the tides. He's been sort of clashing with them on and off. That really does limit what the federal government can do, right? And so I think their other powers, though, I think are going to have more questions than answers once we get past that 5 o'clock hour and past that speech. When are they going to authorize the use of the vaccine for children under age 12? It still looks to be weeks or months away from that.
What is that, Josh? What is the delay with the time frame there?
The FDA is still working on it. This is an age group that would probably get a lower dose as opposed to just clearing the same dose that everyone else 12 and up is getting. So that's been part of the delay on that. Obviously, that leaves a lot of families in the lurch, right? Even if you're fully vaccinated, but you have kids in your home under 12, you have to take precautions still. While other people who maybe don't have kids or have older children are returning to a more normal life. And of course, they're worried about that Delta variant, that the breakthrough cases, although there are real mixed views on how many of those we're seeing. And they're preparing to start those booster shots September 20th. It looks like they're going to start with Pfizer only. Moderna doesn't have his ducks in a row yet, it seems. They're still, going through the process. So that booster question is itself raising questions, because you're putting shots in arms of all Americans, potentially even healthy younger ones that maybe don't need it as much, instead of shipping those abroad.
So meanwhile, the culture wars in the United States heating up, and I do think that this dovetails into the COVID story in a bit, because you have seen a split nation. The latest, President Biden is planning to sue Texas over this abortion law that's been very controversial at the Supreme Court. Didn't really weigh in on, and this basically is the strictest abortion law in the United States. Other states are thinking of following it. I believe it bans abortion after 6 weeks of pregnancy. What is the likelihood that he gains any traction? How much does it just harden the partisan lines in the nation?
I think it's definitely hardening the partisan lines. You know, there's been substantial pressure on the Biden administration to do something, anything, even if it is sort of Hail Mary type legal action. I think we don't really know yet what the fate of that will be, but the Supreme Court's ruling puts Texas on pretty strong footing. Of course, that 6-week timeline, many women don't know they're pregnant until 4 or weeks after that. So that's a very small window. There are no exclusions. He was asked about cases, the governor Abbott in Texas asked about cases of rape, about whether there should be exclusions for that. And he said, well, we're just going to catch all the rapists, and Biden's been pushing back on that. So this is an issue where they are under pressure to do something, where the Democratic, base, for lack of a better phrase, is clamoring for them to just respond, do anything they can to expand access to abortions in Texas. And, but their options look pretty thin at the moment. So, I think they're sort of searching the cupboard, but it's looking pretty bare.
A really serious issue. A sense of the tone of the debate down in Washington, D.C. and beyond. Josh, good to catch up, buddy. Good to see you. Josh Wingrove there, Bloomberg White House correspondent. Some headlines coming from Jen Psaki, the press secretary, the White House press secretary, speaking to MSNBC this morning, an American broadcaster. Jen Psaki saying Biden to talk about vaccine boosters today. The president also to list steps to make COVID testing more available. So when the president does speak, the press secretary saying, Tom, that the president will talk about vaccine boosters and list steps to make COVID testing more easily available.
Okay, they're managing the message. I get it. What are they going to do to motivate the unvaccinated? Villiers nails it this morning.
What did he say, Tom?
Percent vaccinated in Florida, 50-something. It's even worse in Texas, 40-something. Well, I mean, come on, there's two discrete Americas. What does he do to motivate the Southeast to get vaccinated?
Essentially what you're asking, Tom, and Lisa weigh in, is whether we can actually do anything think at the federal level, or if it needs to be done at the state level with the governors of Florida, of Texas,
Should they be able to get on a plane? I mean, I'm asking.
Well, I mean, honestly, and that actually, frankly, is how companies have responded. And I think that the answer really lies with the corporations. I believe there was a survey out on Bloomberg today showing that about half of all major corporations have had mandates for vaccinations. How much are airplanes going to be the new determinants of vaccination, basically saying you cannot board if you're not vaccinated?
You think that's where this could be going?
I think that's already where it's going, basically, that you have certain capabilities or certain privileges. And frankly, there has been no ban on that, right? And you would absolutely get potentially more consumers coming in if they feel safer. So at what point does that dynamic push people into getting vaccinated?
When does the president speak, Lisa?
5 p.m. today.
5 p.m. today, 5 p.m. Eastern time. You will hear from the president of the United States from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Equity futures down 11, 12. We're negative 0.25%. The Dow down 77. It's over. Bull market over, Tom.
Done.
On radio, on TV.
It's a correction.
This is Bloomberg. Live from New York City for our audience worldwide on TV, on radio. This is Bloomberg Surveillance, and here's the price action this Thursday morning. Good morning to you all. Equity futures down 11, 12. We're negative about 0.25% on the S&P. On the Nasdaq, a similar move. A tough, rough time for the Russell more recently. The Russell down about 0.5%. On the small caps this morning, we're down about 11. That's the story of the equity market. Savita Subramanian making some headlines in the last 24 hours. An upgrade to her price target from 3,800 to 4,250. But Tom Keene, did she sound bearish or what? About 30 minutes ago on this equity market.
Yeah, the major observation there, John, to be quick about it, is it's less about equity market dynamics and the Bank of America call wedded to Fed and bond market dynamics.
They're pretty constructive on the economy, just not constructive on this market right now. Switch up the board and get to the bond market, 2s, 10s and 30s. Your next stop for this market in about 15 minutes, an ECB decision. What does that mean for the European bond market? What's the spillover? How does it bleed into treasuries? Right now, 10s, 132.75. Yields in about a basis point. Similar move on 30s. Curve just a little bit flatter. 30s at 194.40. Steve Major of HSBC, he's making a call that we might not see a rate hike over at the Federal Reserve through 2023. What about the ECB? Let's finish on that. Switch up the board and get to euro dollar. For the ECB and Kit Jukes over at SocGen, maybe we don't see it for the whole of this cycle. For a whole generation again. We haven't seen one since 2011. Euro dollar right now, 118.30. Euro dollar positive, a little more than 0.1%. Tom, in about 15 minutes, we'll hear from the ECB and get an idea about the pace of purchases. Yeah. And then there's going to be this compare and contrast between the ECB and the Federal Reserve. A taper at the ECB, if you want to call it that, is not the same as a taper at the Federal Reserve. The ECB has this pandemic emergency purchase program alongside the asset purchase program. Let's talk about PEP for a moment. Has a defined package, an envelope of 1.85 trillion euros, and a loose little bit of calendar-based guidance as well, something the Federal Reserve does not have with open-ended QE, Tom. So it's worth just bearing in mind at the moment that if you use the word taper, taper at the ECB is something very different to taper at the Federal Reserve.
Yeah, we'll have to see what she says at the press conference. That's what I'm focused on.
I can see you're so excited about it. 8:30 Eastern on Bloomberg Radio. I mean, if you had to rest over the long weekend, TK.
He was walking up and down the stairs. The walk up.
Finished our summer reading.
Okay.
All children are accounted for.
Cool. $1, 118.30. Oh, what it's like over at the Tom Keene household. Let's get you some movers this morning. Here's Romain Bostic.
Hey, good morning, John. Let's see if we can perk Tom up here. A lot moving this morning, particularly here in the airline space. All the major airlines out with their periodic updates, Tom, and it's pretty much a story right now about a deceleration in bookings and an elevation in cancellations. Not looking good here. American Airlines, United Airlines saying that they're actually expecting total revenue to be down more than 30% in Q3 compared to 2019, the quarter in 2019, that two-year stack that most of these airlines are comparing themselves to. American Airlines looking for about a 24 to 28% decline down quarter over quarter, and Southwest Airlines looking at about 18 to 20%. All of the airlines looking for a drop here in revenue in the current quarter based on that 2019 comparable quarter. And then you look ahead into Q4, JetBlue actually saying that not only is Q3 going to be bad, but Q4 looks like there's going to be trouble ahead, though it does expect some of the leisure travel around the holiday season to hold up slightly here. All of the major airlines here, United, Southwest, as well as JetBlue, Frontier, all lower here in the pre-market by a percentage point or more. Also in the transportation space, keep an eye on Ford. Those shares down fractionally here this morning. That company abandoning its operations in India. It's going to take a $2 billion charge. Basically, the company really got squeezed there. A real high tax space out there for corporations, combined with an affinity for lower priced cars by consumers. Ford just really couldn't make those numbers work in its favor. Flip up the board. Let's take a look at the retail sector. Biggest percent mover here, at least to the upside, is Lululemon. Shares up about 13% right now, a beat and raised quarter. They continue to be the juggernaut here in this space, strong pricing power, and they seem to be unaffected, or at least being able to navigate some of those supply chain issues. Macy's here getting an interesting upgrade. The share's up about 1% here. Cowen, Oliver Chen and the folks over at Cowen, who've had a neutral rating on the stock going back to 2015, upgrading here to the equivalent of buy. Tom, only 2 buy ratings now on Macy's out there based on this upgrade today. And then GameStop, those earnings have come and gone. Conference call lasted 10 minutes. And Tom, I don't know.
Team meme coverage.
Team meme coverage.
Thank you, Romain. Thank you so much. John Ferro, Delta out there, as Romain mentions, all the airlines reporting, and John Ferro, Delta, saying, August didn't happen, but they had a little bit of a comeback here.
Booking trends stabilized in the last 10 days. That's the headline that comes from Delta, Tom. This is after United Airlines in the previous hour said a deceleration in customer bookings in the last few weeks. So Delta at least seeing a little bit of stabilization, apparently, Tom, in the last 10 days.
Absolutely. When you are Deputy Director of Monetary Affairs at the Fed, you are known to write short, sharp notes. Seth Carpenter has been acclaimed at doing that across Wall Street for years, and he joins us for his first Bloomberg conversation as Chief Global Economist at Morgan Stanley. Seth, congratulations on your new position. You got to go fly fishing with Ellen Zentner. That's the indoctrination at Morgan Stanley. I love the short, sharp note. Everybody calm down about inflation. Why should we calm down about inflation?
I think if you look at the details about what's really driving the inflation, there's lots of reasons to believe the inflation in physical goods really is being driven by supply chain disruptions. We've heard about that for a long time. I mean, when we talk to our equity analysts, it seems like most of those supply chains are starting to get a little bit better, and at best, and at least not get any worse. And so that means that the price level increases for those physical goods should be coming to their end pretty soon. We think we've actually peaked in the US when it comes to inflation now, maybe a little bit later for Europe. But the point is, the price level for those goods affected has probably peaked. They're going to start to ease off a little bit. That's going to pull down inflation for the index overall.
It's maybe not a global question, but I have to go to America. John Ferro mentioning this earlier. Real estate, homes, rents folds into this call, certainly for G10 or maybe even G22. How does housing fold in to a subsiding inflation?
It is the force that's pushing in the opposite direction, especially here in the U.S. The Morgan Stanley team, you mentioned Ellen Zentner, who runs U.S. economics for us, for a long time has pointed to a really bullish attitude we've had on commercial real estate, multifamily home sector. So strong rent increases really will help buoy those inflation measures. So you've got two forces pushing against each other. Rents are going to be creeping up, but we're going to essentially be where we were pre-COVID on sort of the underlying run rate on rent inflation. It sort of surged a bit coming out of COVID after some ups and downs. Now we're settling into, fairly firm, fairly robust housing market. That's going to lift inflation. The reversion, though, when it comes to those consumer goods themselves, that's going to be the things that keeps inflation from rising further from here overall.
Seth, you said that inflation had peaked. Can you help me understand where we stabilize? Do we stabilize at a higher level than where we were pre-pandemic?
So I don't think so. And the one point we've been trying to stress to clients is there's actually two-sided risk. I find the story, the narrative to be inflation is high, it's probably transitory, but there's always the upside risk. And to be sure, we are in very different times, and anyone who has 100% conviction on the outlook is either lying to themselves or they're lying to you. That said, I think there is the chance of downside risk as well. So if you think of supply chain disruptions, if they get fixed sooner than we think, if some businesses have started to add capacity on the hopes of this COVID rebound, then you could actually see those prices fall more than anticipated. And so you've got two-way risk to the outlook for inflation. So where does it end? I think for the US, middle of next year on a 12-month change basis, you could be looking at 2%, could be a bit lower. That outcome, that possibility was highlighted in the minutes to the last FOMC meeting, where the staff forecast has their PCE measure of inflation going below 2% in the middle of next year. I think that's a realistic possibility.
Reminds me of that famous quote. What was it, Seth? I forget who said it. If you interrogate the data for long enough, it'll confess to anything. It feels like the moment we're in right now, doesn't it? If I look at the labour market, I can get this labour market data to tell me things are very tight. I can get it to tell me that things are very loose. When you look at it, what does it tell you?
So I look at a few things. One, I look at where are things happening. So decompose issues in the shortfall we had in last week's data, which was pretty surprising for us on the downside. A lot of shortfall in hospitality and leisure. Not surprising. Ex post, not surprising. The Delta variant surging means that a lot of those industries, they're just seeing a pullback. We think it's temporary. We think Delta will have peaked and will come down, and the recovery will continue. But for me, that's one of the key points in terms of thinking about demand. On the supply side, I look at labor force participation, especially prime age labor force participation. It's been creeping up for the past 3 months. It's well below pre-COVID levels. I think there's every reason to suspect it will continue to rise over coming quarters and possibly even years if we get continued strong growth.
So if we just tie this all together, when you say that inflation has peaked in the U.S., do you include wage inflation in that, or is it entirely a supply chain story?
Very good distinction, very important distinction. I was talking about consumer prices there, and that's the part that's going to matter the most for monetary policy explicitly. Wage inflation is, in fact, a different phenomenon. I think one key point that gets lost, and you can look at some of the research coming out of the Fed from some of their top economists in the Research and Statistics Division, not a huge amount of evidence in the United States of this wage push inflation phenomenon. The link between wage inflation and finished consumer price inflation in the U.S. has actually been pretty weak over the past couple of decades. Wage inflation is clearly strong. There's been lots of disruptions there, businesses having to pay up to hire people back. I think we want to be very, very cautious, however, and look at some of the measures that do a better job of adjusting for composition, because, again, for the last employment report, we saw this big tick up in wage inflation. It was biggest in hospitality and leisure, which is also where we know the underperformance was. So when you're not hiring back the people who are at the middle and lower end of the income distribution, that calculated average hourly earning is going to get biased upward. So I think we want to be super cautious here about any sort of medium and longer term inference about wage inflation.
It was Ronald Coase, just in case You were wondering as well, Seth. Thank you. Good to catch up, Seth. Really good to hear from you. Seth Carpenter, Morgan Stanley, Chief Global Economist from New York. Your ECB decision is 4 minutes away. Full coverage right here on Bloomberg TV and on Bloomberg Radio. Equity futures, -12. We're down 1/3%. This is Bloomberg.
With the first word news, I'm Rishka Gupta. Corporate vaccine policies show a stark divide over employer mandates. Bloomberg surveyed more than 100 big companies. About half have implemented a vaccine mandate for at least some of their U.S. staff. Still, requirements vary widely, and the planned post-Labor migration back to American offices isn't happening as planned. Ford is calling it quits in India after failing to make significant inroads in one of the world's biggest emerging car markets. Ford will shut down its Indian factories and rake a roughly $2 billion restructuring charge. About 4,000 employees will be affected. United Airlines has seen a big drop-off in passenger bookings the last few weeks, believed to be due to the spike in coronavirus cases. The airline now estimates third-quarter revenue to be down approximately 33% versus the third quarter of 2019. United says it expects bookings will start to recover once COVID cases peak. Hackers were able to breach the United Nations computer network earlier this year, and they made off with a trove of data that could be used to target UN agencies. No word who the hackers were. They apparently gained access to the system using the stolen username and password of a UN employee. And for the first time, U.S. antitrust officials have made public the data they're using to help prove Facebook has a monopoly over social networking. The FTC revealed numbers that it says show Facebook is far and away the most dominant social network. The company has said that the case is without merit. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
I think the ECB may tap the brakes a little bit today, but I think they're going to be one of the last central banks to actually increase interest rates, and fiscal policy is going to remain pretty loose. So I actually think the next couple of years, European GDP could be on par or even outpace that in the US.
That's the call from Ben Laidler of eToro, the global market strategist from New York City this morning. Heard on radio, seen on TV. This is Bloomberg Surveillance alongside Lisa Abramowicz and Tom Keene. I'm Jonathan Ferro. That ECB decision is moments away. Here's the state of play in the market right now. Equity futures slightly negative off the back of 3 days of losses. Futures are down 14. We're negative about 1/3% on the S&P. Into the bond market with yields lower by about a basis point to 132.75. In the FX market, euro dollar positive. A stronger euro, Tom, 118.30. That ECB decision seconds away.
Yeah, the currency market is a litmus paper for the global system, really going nowhere over the last number of weeks. Maybe some fractional dollar weakness, but, John, a 117, a 119 on euro, you wonder if you're going to see that. I don't think so.
I have no idea. 118.31 is where euro dollar is going into the decision. Yields in a couple of basis points on an Italian 10-year to about 73 basis points. Let me guide you through the next 45 minutes because this can get really, really messy, and we'll work through it together. In about 10, 15 seconds, you'll get an ECB rate decision. Got to look for some guidance about the pace of purchases within the PEP program. Then at 8:30 Eastern time, so about 45 minutes from now, we'll get a news conference where we'll get some forecasts as well. So rate decision, we're looking for that to be unchanged. It is unchanged. Then we need to start to look for the guidance from the ECB too. So let's work through this together right now. 0 on the main refinancing rate of the ECB. The depot rate, negative 50 basis points. The marginal lending facility at about 25 basis points, also unchanged. Then we get a whole bunch of headlines about the asset purchase program. So let's read out a few of them right now. They slow the pace of PEP. That right there is the headline we were looking for. The Pandemic Emergency Purchase Program, they slow the pace of it. Bear in mind the overall envelope is still 1.85 trillion euros. That's set to go through to March, but they're going to slow the pace of that program after ramping up the pace of it earlier this year. As I say, taper at the ECB is very, very different to taper at the Federal Reserve. There is still an envelope of 1.85 trillion to work through. They've got to about 1.3 trillion. Together with that, there is still an asset purchase program too. But that's the headline right now. They affirm the size of the pandemic emergency purchase program at 1.85 trillion, but they slow the pace of that bond buying. That package has a ton of flexibility. They slow the pace of it moderately. So they set a moderately lower pace for the pandemic bond program. I'll allow President Lagarde to go through the semantics. She will do that in about 45 minutes' time. In the bond market, what does it mean? I've got to say, not a whole lot. In the Italian bond market, we were down a couple of basis points going into this decision. We're down about a basis point now to 74 basis points. In the euro dollar right now, 118.35. That's basically unchanged off the back of this as well. So largely in line with expectations. So Tom, let's put this all together. Rates unchanged, the pandemic emergency purchase program, the overall size of it unchanged, but the pace of monthly purchases will slow somewhat.
Yeah.
What we need to ask going into the news conference, this is the question that's been outstanding for much of this year. When's the emergency phase of this pandemic over? Point one. And point two, if PEP ends in March, or perhaps earlier, I have no idea. If it ends anytime soon, how much flexibility from that program gets carried over to the asset purchase program? And beyond that, does the APP get a boost next year? A lot of that's going to be dependent on the forecast, Tom, that we get in about 40 minutes' time.
To me, the key headline, John, is out moments ago as you were speaking there on PEP, and that is inflation may moderately exceed goal for a transitory period. My answer is, what's the response of Bundesbank to the 47 headlines out there showing the first and second derivatives of a modeled program that's unchanged?
I don't want to preempt the forecast, Tom, but that's the headline, that inflation may moderately exceed the goal for a transitory period of time. Here are the forecasts going into this meeting. We get an update to these forecasts, as I say, I'll repeat, in about 30, 40 minutes' time. But the forecast going into this meeting, 1.9% for CPI this year, 1.5% for next year, and in 2023, 1.4%. was the forecast for 23 going into this meeting. So the news conference is going to be interesting for the forecast as well, Tom, and that's what this policy will hinge on going through to next year.
The dissent here of Bundesbank, which is unspoken, is tangible.
So we get to Maria in Frankfurt. Maria Tadeo joins us right now. Maria, going into that news conference after this decision, what are you looking for?
Well, there's two things, and going back to the point that Tom just made, the hawks make a lot of noise, and we've heard it from the Dutch, the Germans, the Austrians, but if you look at the language here, the ECB says it's transitory, the inflation picture. So it does show that at this point, at this stage, the Governing Council is still very much owned by the doves in that Governing Council. The other thing that will be key for the press conference is they've said we're going to slow the pace of the PEP program, but officials in Frankfurt speaking with me have told me that the key here is that Christine Lagarde will have to make it clear that this is not a taper. The reason why they're doing this is because the forecasts for the European economy are improving, financing conditions are improving. This is not a taper. That's a message that she will have to send in that press conference. This is very different to what the Fed is doing.
Maria, thank you so much. Greatly, I love that. John, would you translate what Maria just said? This is not a taper.
But people don't want to confuse this ECB decision with a Federal Reserve decision. Bear in mind that what the Federal Reserve is doing is open-ended QE, Tom, at 120 billion a month. What the ECB is doing is something very different. And you can imagine a situation where the ECB totally unwinds PEP, Tom, stops buying with all that flexibility, and boosts the asset purchase program next year. As I say, a lot of this is going to come down, Tom, to what happens in the news conference and the forecast we get as well.
We are thrilled to provide clarity here. Maybe Holger Schmieding joins us with Berenberg, their chief economist. Holger, I want to go to the politics of the moment. I'm sure be unspoken within the press conference. The hawks, the traditionalists at the ECB, which you have beautifully enunciated over your career. How does Bundesbank respond to this semantic jumping through hoops on dovish practices?
Well, the Bundesbank won't quite like it, but what we probably will learn is that today's statement, today's press conference, is only the prelude to the really big decision. The hawks will now probably try to sum up all the strength to influence the December decision. In December, the ECB will probably not be able to duck the issue, namely, when does the emergency end? When does the PEP emergency program have to end? And as a result, expect the hawks to make quite a few noises in coming weeks to prepare for probably a decision in December that will be hotly contested and may give us a better clue about the genuine tapering that will come at some time next year, whether it starts in April or whether it will take longer.
Holger, this is really difficult for people to follow because there's two programs running in parallel. There's PEP on the one side, there's APP on the other. If they end PEP, because as you say, the clue is in the name, emergency, if that ends, what does it mean for the asset purchase program?
That's another big open question. It probably will mean that the normal asset purchase program is beefed up, and I expect it to be made moderately more flexible to react to market conditions, but to not be anywhere as flexible as the current emergency program. So the compromise will likely be, in my view, and it will be hotly contested, that in December the ECB tells us, yes, the PEP, the emergency program, will be phased out from April onwards. At the same time, the standard program that is open-ended will be raised a bit and made more flexible. So, but that's the debate for the next few weeks with the December decision, rather than anything we will probably learn the details about today. Today is probably just the day when we may learn, yes, there is a serious debate going on, and they have agreed to disagree until December.
On a broader level, Holger, the message from the ECB is similar to the one from the Fed. They will use all tools to get the average inflation rate at target. Even if it exceeds temporarily, they're not going to be phased by that. And frankly, they talked about potentially even adding accommodation should that become necessary. This was incredibly dovish. And you do see bonds in the Euro region actually rallying to a significant degree. Is this basically the market saying that they don't believe that the ECB could ever reach that goal that they're setting out in inflation?
Well, the ECB statement today seems to be almost the same as the previous statements, so that is no change, except for this moderation of the pace of asset purchases, which, however, was flagged in advance so much so that the bond markets, you could say, reacted already to that. Again, the outcome of what we will hear in December at the real decision is open, and the hawks will probably in coming months get even higher inflation rates, transitory, but higher inflation rates to make their point. So that will be very interesting.
Question in the presser for President Lagarde, Holger. What is it?
Sorry, say it again, please.
Have you got a question for President Lagarde in the presser, the news conference in about 37 minutes' time?
My key question would, of course, be how flexible can the standard asset purchase program be, the open-ended program, once the ECB finally declares the pandemic emergency over? It's not just the size of asset purchases, also this flexibility to react to market conditions, which is, if need be, help Italy and the like. It is also that element which really, among the hawks, is hotly contested, and that's putting it mildly.
We did not discuss that at today's meeting, Mr. Smeeding. We are committed to financial conditions remaining easy through the projected horizon. Holger Smeeding, thank you. You know what's going to happen at 8:30 Eastern. Berenberg Chief Economist, thank you
100%.
very much.
This is tapering.
So a rate change, no rate change, as expected, a guidance change, a pace of purchase change at the ECB. Tom, as Holger points out, the bigger questions are going to be asked at the end of the year. When PEP ends, how much flexibility runs over from that emergency purchase program to the open-ended asset purchase program? That will define how easy, so to speak,
John,
this ECB is going to be.
You're way expert on this versus me or Lisa. How is dissent colored at the ECB? If Belgium and Bundesbank, Germany Bundesbank, can dissent, is that a visible dissent like here, or even more so?
This is how it often plays out, Tom.
England?
Unfortunately, this is how it often plays out. You're going to get the decision. We've just had it. We'll get the news conference. Maybe during the news conference or immediately afterwards, Tom, you'll get a story that comes out according to sources close to the decision. They'll make themselves heard pretty quickly. They'll be looking to set the tone going into year end. It's not about a win today, reducing purchases, this pace of purchases. That is not what this is about. This is about shaping the program beyond next year and limiting the flexibility, for the hawks at least, not my view, but for the hawks, limiting the flexibility in the emergency program from spilling over to the asset purchase program. So there's something for everyone here going into next year. And Tom, a lot of questions still unanswered.
I go back to the chart Lisa showed earlier, the balance sheet buildup of ECB, Fed, and all of them. It's all the same. There's no textbook that covers what we're talking about.
It's staying that way for a long time. Let's be clear about that, Tom. It really is.
No textbook.
Tom Keene, Lisa Abramowicz, Jonathan Ferro, your equity market down about 1/10%. Yields in Italy.
Huge move.
Yields in Italy down about 4 basis points. The euro stronger by 0.2. What a morning. Welcome back, Tom. From New York, this is Bloomberg.
I'm Danny Kleppinger with an exclusive U.S. Open update for Bloomberg TV and radio from Tennis Channel. The women's semifinals are set after Wednesday's action at Flushing Meadows. Great Britain's Emma Raducanu continued her fairy tale run in New York as she took out Olympic gold medalist Belinda Bencic in a dominant straight sets win. The 18-year-old becomes only the third woman ranked outside the top 100 to reach the Final Four at the Open. She'll face Maria Sakkari for a spot in the final after the Greek star got past former runner-up Karolina Pliskova to reach her second semi at the Slams this season. 6-4. Sakkari lost just 1 point on her first serve and fired 22 winners in what was a very impressive performance. And don't forget, you can watch all the action from Flushing Meadows every night on Tennis Channel. I'm Danny Kleppinger.
We are seeing transitory surge in inflation.
This is not a market of everything is going to go up, everything is going to win.
It's all about the fundamentals. Earnings expectations are still rising.
When we look at consumer finances in general, there's still potential for the consumer to spend over time.
Everybody's talking about supply chain risk and inflation. We're actually starting to see that come in the numbers.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. An interesting day. Lagarde in this hour with her comments on taper, non-taper, mini taper, maxi taper, and the rest of it. We'll have too much coverage of that as we get to 8:30. Selling the hell out of it, John. You know, what matters to me, John Ferro, as we heard in the opening there, and the guests are the quality of what we do at Bloomberg Surveillance. Ben Laidler outlines the fundamentals of the equity market, and Savita Subramanian goes the other way, and the distinction is she's focused on the bond market.
Bank of America looking for 42.50 year end. It's an upgrade from 3,800, but it's nowhere near some of the price targets elsewhere. And into next year, we've heard calls of 5K, Tom, 4,900, 48.47. Savita's looking for 4,600 on the S&P 500. And that divide exists, Tom, beyond the market, in economics as well. That's been a theme for this program so far this morning. Take a look at the labor market. I can give you some data that shows you this labor market is tight. I can give you some data that shows this labor market is loose. That debate's going nowhere anytime soon.
The distinction, John, on ECB is simple. U.S., maximum stimulus. ECB, far, far, far less stimulus.
Look, let me put it this way. Capital Economics, their line, it came out a couple of minutes ago, and I think it sums things up perfectly. The ECB slows purchases, but will keep policy ultra loose. The real test for that, it's in the Italian bond market. The Italian bond market is rallying. Yields are lower this morning.
What does that mean for the Bundesbank?
For the Bundesbank, right now, let's see what you've got. Jens Weidmann going into year end. Can you make sure that the flexibility in this pandemic emergency purchase program does not get folded over to the asset purchase program next year? Let's see what the forecast looked like for one, Tom.
The smartest thing I've heard in the last, I was off a sabbatical a long time, folks. I'm just getting back into it. Lisa, you talked about the pendulum of the S word. And so there it is. Stagflation's really what we're all talking about.
And just to be clear, before John starts rolling his eyes at me, which I'm sure he will, it's hard to talk about stagflation when you're looking at a GDP growth rate of 5% in the United States, right? This is hard to call this some sort of dismal backdrop economically. However, this dynamic of peak margins, as Savita Subramanian was talking about, Seth Carpenter talking about peak inflation, at least in with respect to supply chain disruptions in the goods and in the commodities. How much does that give way to the fundamental weakness that has been overlaid by the pandemic? And I think that a lot of people are trying to figure that out right now.
You know, I'm going to just say simply the VIX comes in, John, from 19 gloom into 18.27. John, red and green on the screen. The Dow red, the NASDAQ green.
The S&P 500 just a little bit red. Let's whip through it together,
Let's
Tom.
do it together.
We're down 2 on the S&P. It's beautiful,
so
isn't it? This
sweet.
partnership
It
means so much to me. I missed you too. We're down 0.05%
I think I just
on the
threw
S&P.
up a little in my mouth.
Yields off the lows, 133.26. The euro near the highs of the session. Euro dollar 118.41. Slightly stronger euro in the mix, Tom. That news conference starts in about 26 minutes. We've got jobless claims too, TK. We'll get to claims before that.
You know, like a lot of our people watching across this nation and frankly worldwide, that's what Wednesday's about. You take your kids back to school, you start drinking early. I mean, John,
Is that what your long weekend was, Tom? A long weekend. I did wonder where the energy levels were first thing this morning after your 3-4 day sabbatical.
Always with a good energy level. David Riley saves us right now with Blue Bay Asset Management. David, I make the economic distinction of massive stimulus in the United States. How constrained is Christine Lagarde with a lack of U.S.-like stimulus in Europe?
I think it is a constraint, and I think that the decision today to reduce the volume of asset purchases, however moderate that may be, and maybe we'll get some insight into that from Lagarde in the press conference, is it's a taper to me. I mean, you're reducing the volume of asset purchases. We know that there's an end point as well for the PEP. So it sounds to me that it is a taper. I think it's kind of been well flagged within the market, which is why we're not really getting any kind of meaningful reaction. But I think it's quite a contrast, as you've highlighted, Tom, with the US, where there's still debate about additional fiscal stimulus on top of the huge stimulus that we had this year and last, but also where, you know, inflation really is running above target and has actually been averaging over 2%, arguably over the last 3 years on average. So, you know, the US isn't facing a kind of disinflationary, deflationary trap, and yet I think that Europe is still facing that potential, and yet we're having an ECB that de facto is tapering before the Fed.
David, the words do matter, though. Tapering at the ECB is not the same as tapering at the Federal Reserve, because we could get a boost to the asset purchase program next year. So ultimately, what does it all mean for markets? Personally, for whatever my view's worth, if the Federal Reserve is doing that, it's removing accommodation. If the ECB is doing it, I just don't know the answer to that until next year.
No, I think that's fair, which is what happens when the PEP comes to an end to the sort of broader QE asset purchase program, and the presumption in the market is that that will be increased, but we don't really know by how much it would be increased. We also don't know, as you've been speaking to with your guests as well, in terms of the sort of flexibility. I mean, there's a lot of constraints around, sort of self-imposed constraints around QE that the ECB has, which the Fed doesn't limit itself by. So I agree with you. It's just, look, you know, we had in July an ECB conclude a strategic review and said it's, 2% symmetric target. We're going to do whatever it sort of takes. And at the following meeting, it's marginal, right? Maybe we're debating sort of angels on a pinhead. But at the margin, it's a marginal reduction in the rate of easing, if you want to describe it in that way.
So, David, considering the fact that a number of guests have come on this show and said that they like Europe over the U.S. when it comes to riskier assets, in particular stocks, do you disagree with that assessment? Because you do think that, in effect, the ECB is taking more of a tightening or less easy approach than the Fed at this point.
Well, I think it varies according to the asset. So, for example, in European corporate credit, it's been incredibly low volatility, really very much not much happening, and actually most of the corporate bond purchases have actually been done under the QE program rather than a PEP. That's likely to continue, so that's fine. I think that actually is a reasonable place for investors to be. I think with respect to more sort of growth-sensitive assets, I just think there's more willingness and policy levers in the US, both monetary and fiscal, in order to have a breakout in terms of growth, have a breakout from the sort of secular stagnation fears than there is in Europe. So I think over medium term, I would expect, US growth-sensitive assets to outperform. I think equities over the medium term, US equities will continue to outperform.
David, with that optimistic tone on the American stock market, how do you, as a bond guy, respond to equity strategists basing their equity call to a heavy weighting on central bank and bond dynamics?
Yeah, I think what we've seen, though, I think within the, sort of equity market is what's kind of going on under the hood. And I think for equity investors, obviously the bond market matters a lot, particularly for this kind of, relative performance of growth, long duration growth stocks, US tech versus value. I do think that real rates are too low in the US. I think part of that is due to the distortions created by the Fed in its purchases of tips, and that once the Fed does start to taper, we will see real rates move higher, and that is going to be, in the short term at least, I think, a headwind for growth stocks, and therefore a headwind for some of the headline the S&P and some of the headline equity indices. But you asked over the medium term, where would I kind of place my bets as to who's going to sustain the recovery and avoid being sucked back into a kind of secular stagnation environment? Then I would say the US over Europe, and therefore that would make me more bullish over the medium term for US growth assets.
David Riley, interesting stuff, as always, of Blue Bay Asset Management, the chief investment strategist. Let's round things up for you. Equity futures in the United States just off the lows on the S&P 500. We're down 3. We're negative 0.06%. Treasury yields, they erased the rally of the morning as well. We're now higher by almost half a basis point. Marginal move, but we were lower by a couple of basis points on 10s, now 134.10. In the bond market, euro dollar, euro stronger by 0.2 at 118.38. And it's the Italian bond market that gets my attention going into this ECB news conference, Tom, in about 20 minutes' time. Yields in by 3-4 basis points to about 72 basis points on an Italian 10-year as the ECB reduces the pace of purchases, but no doubt President Lagarde will be very keen to emphasize that they remain very, very loose when it comes to accommodation for financial conditions.
John, where's the bid on Italian paper? Is it like a Draghi trust? Is he runs the country? Is it something else?
For the confidence in BTPs?
Yeah.
I think politics is part of it. If you think of the last gap wider we had, Tom, back in 2018, that was down to political uncertainty outside of the pandemic. A lot of that was about political uncertainty and the future. I think people look to Draghi as a bastion of stability, maybe. But, Tom, for me, this comes down to the ECB. For the ECB, from the market's perspective, the Italian bond market is the North Star, and financial conditions have got to remain loose for the country in Italy and for the periphery too.
I'll start watching that. I've never...
I think you've been watching it for the last 10 years, and maybe longer. Yields unchanged on 10s, 133.93.
Lake Como Water Company
Equities
bonds.
Unchanged. What bonds have you got?
Lake Como Water Supply.
Oh,
they did the pipelines up to George Clooney's place.
You're long Lake Como?
Yeah.
Nice. Lake Como or Lake Como?
Perry Como. Yeah,
okay.
Perry
just wanted you to
Perry had a
emphasize
place there,
and highlight and just clarify for us, Tom. Thank you. News conference 20 minutes away. Less of us, more of Lagarde coming up on Bloomberg Radio. That's a promo these days, Tom, and on Bloomberg TV too.
You just sold it like crazy. I tell you.
We won't be on.
More of her and less of us coming up in 20 minutes from New York. This is Bloomberg.
How about those Red Sox?
With the First Word News, I'm Rishika Gupta. The White House reportedly will unveil a plan today to cut prescription drug prices, according to the Dow Jones. The plan would push to empower the federal government to negotiate for lower drug prices in Medicare and then pass those savings onto the private sector. The pharmaceutical industry says that would reduce the funding for the development of new drugs. Traders are rushing to dump Chinese tech stocks. That's after Beijing took aim at gaming companies for focusing solely on profit. Executives from a number of companies were summoned to a meeting where they were reminded of their obligations to society. One of those companies was Tencent Holdings, which fell almost 9% today. Also in China, inflation at the factory level was hit a 13-year high. Producer prices rose 9.5% in August from a year earlier. That was driven mainly by higher prices for those commodities. Output prices in the coal industry grew the fastest, up 57% from a year ago. Goldman Sachs is dropping social distancing rules in its London office and will return to full occupancy next week. According to an internal memo, Goldman's already is seeing about half of its London staff in the office each day. The firm is also ending free meals in the office. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
I would love to see us sooner rather than later start taking our foot off the accelerator, because I think the longer we make these purchases for longer than necessary, I think it may actually make it so that we have less flexibility down the road.
Robert Kaplan there, the Federal Reserve Bank of Dallas president from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Here's the price action in the equity market. We're 12 minutes away from initial jobless claims data in America and a news conference with President Lagarde of the ECB in Frankfurt, Germany. Yields on a 10-year unchanged at 133.42. Euro stronger. Euro dollar 118.37 in the equity market, erasing some of the losses of this morning. Still negative, though, by 3 points. We're down almost 1/10%. If you want to read on what's happening in Italy, I'll give you one just very quickly. The Italian bond market is bid. Yields are lower by 4 or 5 basis points to about 70 basis points on an Italian 10-year, Tom. So a rally on the periphery this morning.
Very good. This is a joy. We had a lot of different opinions on the market today, but I'm going to be clear. If you're an optimist or you're wondering what the optimist theme is, on a global basis, there's no one that delivers that tone right now. That narrative, like Jay Pulaski with TTW Investment Management after a sterling career at Morgan Stanley. Jay, I am thrilled to have you here. I have been a glasses half full guy, and I want to cut to your analysis where you talk about stellar earnings. Is that discrete to America, or is that global stellar earnings?
It's global, Tom, and I think this is one of the key points because we're probably in the early stages of the handoff from liquidity-driven markets to earnings-driven markets. So it's important that earnings continue to deliver, and they have delivered not only in the U.S., but also in Europe and Japan, a little bit less so in emerging markets, but I think that's going to change as we move forward. I'm looking for a synchronized global expansion as we exit 2021 and focus on 2022, which I think is where we're starting to focus. And that is going to support continued earnings growth, which is going to support continued higher equity prices, particularly outside the U.S. And right now, at the moment, very bullish on Asia. Let's not bury the lead then. Asia. Why Asia, Jay? Well, I think we're about to see the true reopening, John. I've talked about a synchronized global expansion for the last couple of quarters. We haven't really seen it because we had when Asia was open at the early part of the year. Europe was closed. Now Europe and the U.S. are open. Asia has been closed, right? We had PMIs in China and ASEAN at around 45. That's a sign of a lockdown. Goldman has a good lockdown index, which is starting to show Asia lockdown easing. I think that's going to impact the cyclical side of things. It's going to impact the commodity side of things. EM has been a big underperformer. Every day it's China edicts knocking down China tech shares. I think there's an opportunity there. We're overweight Japan. And we're adding to Asia ex-Japan as we speak. Asia ex-Japan. Do you do Asia ex-China as well, Jay? And how easy is that actually to do in practice? Yeah, it's a great question, John, because as you know, I focus primarily in the ETF space, and it's difficult. I'd really like to buy ASEAN, for example, right? The Southeast Asian nations, because I think that's where all the dynamism is in terms of consumption and production. As the supply chains, as the lockdown eases, supply chains reopen, that's a segment where you're going to have a lot of action. Very hard to buy. There is an ETF. It's completely illiquid. So you got to do individual country funds, which then becomes a problem. You have 5 funds for Asia. You know, how many funds are you going to have and how many ETF positions are you going to have? So it is actually quite a bit tricky. But you play that also through the commodity side, and there the ETF space is pretty good. So I think we're going to be able to find our exposure.
So when you talk about supply chain disruptions, I do wonder how this factors into the cyclical tilt that you are giving your portfolio. This idea, they are ongoing. This is going to be a problem, and frankly, it's crimping growth and profitability. What is your call? When are these supply chain kinks worked through?
Well, yeah, at least I think that's great. I don't have the crystal ball. I wish I did. So I don't know when actually it's going to all be done and perfect. But I think we're going to get better. Look, Asia is the production factory for the world. It's also where 2/3 of the annual GDP growth comes from. And so the fact that Asia starts to reopen, starts to grow, China airline departures, for example, were up 30% over the last month after their short lockdown. So I think as we move forward, as Asia reopens, that's the start of the production reopening. That's the start of the kinks and the supply chains easing. And look, companies are having record margins, so we can talk about supply chain disruptions all we want. But the reality is, back to Tom's original point, margins, corporate margins, all-time highs. Earnings growth, 30%. Bank of America one-year forward earnings growth estimate globally, globally, is at 30% year over year. Equities are not going to go down when you have 30% earnings growth year over year. Flat statement.
Well, and what Savita Subramanian is saying is that perhaps we've got peak margins. But just going to your China call, and you can argue against that another time, but this question of ex-China, when you cite China as the center of a lot of these infrastructure types of plays that could be potentially positive, are you staying away from China purposefully because of some of the regulatory uncertainty?
No. No, as I said, I am holding our China positions. We have China healthcare positions. We have China broad tech positions, and we're holding them. We haven't sold them. We've been holding them throughout this entire couple of months. It's been a little bit painful, but look, the growth in China is going to continue. And I'm more worried about an Evergrande, the big property developer, an Evergrande implosion than I am about continued China edicts.
Wait,
I think China's doing a lot.
Do you actually see any contagion or any signs of a contagion from the Evergrande situation?
Not yet, but I think it's something that we should all be worried about. It's huge, it's indebted, and the bonds are basically trading as if it's going to go bankrupt, particularly the offshore bonds.
Come on, Jay, they're just going to write it down. I mean, the government's going to step in as lender of last resort and take the thing down to zero, and we move on, right?
Yeah, and they're going to stiff the offshore bondholders, and that's probably already in the price. For the most part, I think you're right, Tom. But the question of China and the question of these edicts that keep coming out and the impact on the stocks, I think for the most part it's already bottomed. I made the case that Delta was discounted back in July. I think China government edict were discounted 2 or 3 weeks ago. We haven't come back to those price levels, and I don't think we're going to. You can't keep beating the same drum and have the same impact. Markets are too smart for that. We've already moved on, and I think the focus is the PBOC going to ease down the road here? I think that's quite likely, and that's going to provide support. And look, China, I think my old colleague Stephen Jen, we had a great call yesterday. He runs his own hedge fund in Europe, Morgan Stanley FX strategist. He said that this is all a kind of a shakedown. Right? The Chinese government is long state-owned enterprises, which are not growing. They don't have a play in the private, fast-growing tech sector in China. They want that play. They're going to drive the price down, and then they're going to start to take positions through other entities. You saw the first foray here with Didi in the last couple of days, talking about state-owned enterprise taking a stake in Didi. So I think there's a lot going on here. China understands it needs to raise capital. They have tremendous needs to raise capital, and so they're not going to kill the equity market. This is a social issue, and we're probably 2/3 of the way through it.
Hey, Jay, you run down the clock. We didn't even talk about Europe, but there you go. That's your fault, not mine. Jay Pawlowski of TPW Investment Management, founder and principal. A headline crossed on a Bloomberg: China releasing national crude oil reserves for the first time. WTI, now unchanged on the session, was positive. From New York, this is Bloomberg. Live from New York City for our audience worldwide, heard on radio, seen on TV, this is Bloomberg Surveillance. A couple of things to get through now. Jobless claims coming out in just a couple of seconds' time. After we break that with Michael McKee, we'll then turn to an ECB news conference in Frankfurt, Germany with President Lagarde. Equity futures this morning down about 6 on the S&P, negative a little more than 0.1% on the S&P 500. Yields in almost a basis point to 132.92. There are the numbers, there's the data. Here's Mike McKee.
Well, John, we've got some really good news on the jobless claims front, which is a little bit of a surprise. 310,000 jobless claims. That's down from a revised number of, let me see here, 354,000. So at this point, it is a big drop, and it is the lowest since March 14th of 2020, when it was 256,000. So we're getting slowly back down to the pre-pandemic level. And at 310,000, one would expect that we could get down to the 200,000s, which at one point we thought was unbelievable, in the next couple of weeks or so, depending on the seasonal adjustments. I'm just looking here. I don't see any indication that states had to estimate claims. And the reason I said claims might be a surprise was because of Hurricane Ida. And so maybe next week we'll see some effects from that, because the people who couldn't get to work would be filing.
Mike, thank you. The right kind, a downside surprise on initial jobless claims at 310 against an estimate of 335. Very little price action off the back of this. Yields coming in by almost a basis point to 132.92. Tom Keene, I can see they've entered the room in Frankfurt, Germany for the ECB news conference. President Lagarde standing by for photos alongside the ECB Vice President, Luis de Guindos. Do you think this is going to be a testy one? We'll get those forecasts in just a moment too.
I mean, it's dazzling. There's 3 of them there. They're set as like fancy versus what Chairman Powell does. I love the podia. I think they're, really.
Do you like that?
Really appropriate.
I thought you might like the design of the room, Tom.
It's blue. It's Frankfurt blue.
Do you think they copied us?
Could you imagine, John? Seriously, could you imagine if Axel Weber or Otmar Issing was up there right now,
standing at a podium?
Yeah.
Can I imagine him standing, or can I imagine him talking the same way President Lagarde will be talking in a moment?
It'd be a different tone than what we're going to get from Christine Lagarde.
Well, let's get that tone right now with the ECB President Christine Lagarde about to deliver that news conference after leaving rates unchanged but adjusting the pace of the pandemic emergency purchase program. That news conference is just about to begin with euro-dollar at 118.30 rather, positive a little more than 0.1%. President Lagarde just receiving her introduction. Let's take a listen.